Dollar cost averaging, or DCA, is one of the most popular investment strategies out there, but why is it so effective? Is it truly the best strategy that everyone should be using? In this video, we're going to be covering the psychology behind DCA and how it can help keep you consistent so you do make emotional decisions. Let's get into it. Hey guys, what's going on? This is DCA Crypto Investor, and today I'm gonna be talking about why dollar cost averaging is such a great strategy and why it keeps you consistent. Now, if you're new here, I post weekly updates on my long-term crypto and stock portfolio. But here's the thing, most investors fail. And although it's not because of the math when it comes to the strategy that they choosing, it's actually because of the psychology that they have around money. So, it's their emotional attachment to the investments that they make, and this leads to making bad decisions. So, today I want to go through and cover how DCA helps eliminate these emotional attachments to your investments. Alright, so before we talk about how DCA keeps you consistent, we need to talk about the emotions that cause most investors to become inconsistent. Now, there are many emotions that cause this inconsistency, but the three main ones that I think about are FOMO, fear, and greed. So, let's talk about each one of these quickly. So, first up, we got FOMO. FOMO stands for fear of missing out. And this usually happens when the price is shooting up very fast. We see this all the time in crypto. One of the best examples that I can remember was back in December of 2017, where Bitcoin shot up from like $13,000 to almost $20,000 in just a few days. Now, this is a period of time where many people were experiencing FOMO, and it got really bad when Bitcoin had its all-time high at $20,000. Everyone that knew about Bitcoin felt like they missed out on thousands of dollars that they could have made during that bull run. Or take GameStop for example. Remember the whole GameStop short squeeze that happened earlier this year? Well, there was a lot of people who did invest in GameStop because they did know about it. And then once they started seeing the headlines online, well, that created FOMO. They wanted to get involved and buy the stock, too. So, you can look at any asset that has ever increased in value, and you will find people who regret not buying it earlier. And this regret is what fuels FOMO. Next up, we got fear. Fear is the emotion that's driving panic selling. Take a look at this chart. This is Bitcoin throughout 2020. As you can see, it shot up significantly throughout the year. However, right before it shot up significantly in December, we had a huge dip. We call this a Christmas pump. A lot of people bought Bitcoin throughout the year, but then they panicked sold once the price dipped. And this happens all the time. Or take a look at the 2020 stock market crash. This was a crazy time because it happened so fast. The market dropped 30% in just 1 month. Imagine if you were an investor who put all your money into the stock market that month and you were unprepared for it. Well, that's exactly what happened to a lot of people. And that's why fear causes panic selling. And lastly, we have greed. Now, greed is what causes investors to try to catch a falling knife. So, let's say an investor sees a chart like this. Now, this is a chart of Bitcoin throughout 2019. You can see that the price stayed pretty low until March. Then, once it shot up, there was a lot of people who thought that the price was going to go even higher. So, those people bought in at the peak, thinking that the price was going to shoot up even higher. But then the price ended up dropping. And then you have investors who bought in at the peak trying to catch the next wave of the upside, only to find out that the price actually went down. And this is the same type of behavior we saw in the 2009 housing market crash. Housing prices were rising so much that a lot of investors thought it was impossible for them to rise anymore. So, they started trying to buy houses at the peak thinking that they would continue to go higher, but they ended up crashing. Alright, so now that we understand the common emotions that lead to poor decisions, let us move on to the next part of the video where we talk about how DCA eliminates these emotions. Alright, so how does DCA remove these emotional traps? First off, DCA removes the emotional trap of fear by implementing a set and forget system. So, what I mean by that is, you schedule your purchases ahead of time, and then you stick to that schedule. This means you're not making your investment decisions based on current events. Instead, you're making your investment decisions based on your long-term goals. Take a look at this calendar. Now, imagine that you're going on vacation for 2 weeks, and you know that you're going to be away from your phone and your computer. Well, if you use DCA, you wouldn't have to worry about your investments. While you're gone, because you already scheduled your purchases ahead of time, and you're just gone, let them play out. Let's move on to the next emotional trap, which is FOMO. And the way that DCA removes the emotional trap of FOMO is by having a set and forget system, meaning that you're going to consistently be buying into the markets, regardless of the price. So, this means you're not trying to chase past returns. You're simply setting aside money each week or each month to invest, and then you're letting that money work for you. Now, this may sound simple, but it is actually a really powerful way to invest, because it takes away your emotional attachment to your investments. And finally, let's talk about greed. Greed is one of the worst emotions that you can have as an investor because it leads to reckless decisions. Now, DCA removes the emotional trap of greed by implementing a set-and-forget system. Now, what I mean by that is you're reinvesting a predetermined amount of money every week or every month, and you're not changing that amount no matter what happens. Now, this might sound counterintuitive because you may be saying, wouldn't I make more money if I invested more when the market is down, and I invested less when the market is up? But this is where you'd be wrong. In fact, behavioral finance research shows that consistency beats timing every single time. Now, I've actually done a whole video on this topic in the past, but I just want to summarize this real quick. So, let's take a look at this graph. Now, this graph shows the results of a study done by Dalbar Inc., in which they compared the performance of 3 groups of hypothetical investors. The first group is called the consistent investor. They put $100 into the market every month no matter what. The second group is called the market timer. They only invest in the market when they believe it's at a low point. So, basically, they're trying to buy at the bottom and sell at the top. And the third group is called the buy and holder. They invest $100 at the beginning, and then they never touch it again. Now, as you can see, the consistent investor outperformed both the market timer and the buy and holder over the long run. And the reason for this is because the consistent investor was able to take advantage of the power of compounding over time. So, in simple terms, DCA makes you a better investor because it helps you overcome the emotional traps that most investors fall victim to. Alright, so I hope that you enjoyed this video, and I hope that you learned something new. If you did, please hit that like button. If you're new here, consider subscribing and also check out my other content. Thanks for watching, and I'll see you next time.